How much money exactly do you need to have invested in the stock market to be able to live off of dividends? That is the question I'm going to be answering in today's video. So if you do enjoy, make sure to drop a like on the video as it does help support my channel. And if you haven't already, please consider subscribing for more investing content just like this coming very soon. Anyways, dividends are known as one of the purest forms of passive income that people use to supplement their lifestyle incomes, whether it be for retirement, paying expenses, or for leisure spending. Essentially, dividends are just cash distributions from a company's profits paid directly to the shareholders, and this is the most direct way that a company can benefit you as the investor. So in order to earn dividend income, you don't need to do anything other than holding a company's stock that pays out regular dividends. It's really that simple. Now, most dividend paying companies like Johnson & Johnson, for example, will pay out quarterly dividends, meaning that you will consistently receive a dividend payment every 3 months. But there are companies that will actually pay out monthly dividends. For instance, Realty Income is one of them, or even semi-annual dividends in some cases, like Disney did before they suspended their dividend in 2020, but these ones are quite rare. At the end of the day though, it really doesn't matter how frequently a company chooses to pay out their dividends, because the annual yield that you will be receiving will remain the same. For example, if you buy a dividend paying stock with a yield of 4% and they pay out quarterly dividends, you're going to be receiving 1% of your investment every 3 months, which in total at the end of the year adds up to 4% given those 4 payments. But if you buy another dividend stock that pays the same yield of 4%, but then they pay it out monthly, that means you're going to be receiving 0.33% of your investment every month, which adds up to 4% given those 12 payments. Now, it's also very important to recognize that just because you buy into a dividend paying stock with a fixed dividend yield, it does not mean that that dividend yield is going to stay constant over time. Companies are never obligated to pay dividends or even continue paying the dividends, even if they've been doing so for decades in the past. So at any point, a company might choose to slash its dividend, just like Disney did during the global pandemic of 2020, since all of its parks were closed and they needed to retain the cash. Now, on the other hand, many great dividend paying companies will actually choose to raise their dividends over time, like year after year, and these would be known as dividend growth companies. And when you hold a stock like this, it essentially just means that you're getting a pay raise every single year simply for holding the stock and doing absolutely nothing, and that is the true beauty of dividend growth investing. And because of this dividend pay raise, your dividend yield on cost will actually go up. For example, if you invested $1,000 into TD Bank stock, your current yield would be approximately 3.5%, but if they raise the dividend 10% next year, which they have been doing many years in a row now, your new yield on cost would become 3.85%. Some other examples of great dividend growth companies are Coca-Cola, Johnson & Johnson, Apple, Microsoft, Realty Income, and many more. As dividend investors, we need to be able to choose amazing companies just like these that continue paying and growing their dividends over time so that we're able to live off of these dividends. So now let's jump into some scenarios to be able to figure out exactly how much you need invested to be able to live off of your dividend payments. Alright, so it's very simple to figure out how much you need invested to live off of dividends. The only thing you need to do is take your annual income and divide it by the average dividend yield of your investments. So for example, let's consider that you plan on owning J&J stock, which is Johnson & Johnson, for the rest of your life and living off of their dividends, since they are known as one of the best dividend growth stocks. And since I don't know your salary, I'll be using the annual average salary across the US, which in 2019 was $52,000 approximately. But realistically, in 2021, it's probably going to be higher, and you'd want to earn a little bit more on top of the average salary, so let's assume $60,000 is your annual average salary. Next, we need to find Johnson & Johnson's current dividend yield, which would be sitting at 2.59% at this very moment. So to calculate the amount that you need invested in J&J stock to earn your annual wage, we would take $60,000 and divide it by 0.0259, which is just the 2.59% divided by 100, and we get $2.3 million. This means you would need to own $2.3 million or 14,145 shares of Johnson & Johnson stock just to be able to earn your average annual salary of $60,000 per year based on their quarterly dividend payments. Now, obviously, that's a lot of money that you need invested just to be able to earn a $60,000 per year salary. Luckily though, you can reduce the amount that you need invested in a stock by choosing a stock with a higher dividend yield. For example, let's say you choose to invest all into Realty Income stock, which is a consistent dividend paying company that has been growing it year after year. And right now, Realty Income has a dividend yield of 4.04%, which is quite a bit higher than J&J's dividend yield of 2.59%. So now let's do that same calculation as before by taking the $60,000, now dividing it by 0.0404, which gives us $1.485 million. So this is quite a lot less than the previous example, but on average, you're going to need about $1.5 to $2.5 million invested in the stock market on average to be able to live off of your dividends. And there's no denying the fact that this is a ton of money that you do need invested to be able to live off of your dividends. Also, you'd probably want to diversify your money across several different companies that pay dividends, just in case one of them cuts their dividend, your income would not be gone. But there is another way that you can achieve this target without needing all of this money up front. All you need is a little bit of time and some compounding, and you can achieve the same results. And this I'll be getting into right now in part 2. Alright, so it's quite likely that most of us won't have $2 million sitting on the sidelines just to be able to deploy into a stock, but what we can do is grow the money that we do have over time with a little bit of compounding, and that's what this detailed method is all about. In the last example, we didn't consider compound interest, and we also didn't consider the fact that dividends grow over time. We just considered the starting yield and a constant scenario. As I mentioned before, some companies are very well known for consistently paying but also increasing their dividends over time, and some of those companies would be Realty Income, TD Bank, Apple, Microsoft, and several more. And if you continue to hold stocks just like these that increase their dividends over time, your yield on cost will rise significantly over time. For example, when Buffett first bought shares in Coca-Cola, his starting dividend yield was probably around 3 to 4%, but nowadays his yield on cost is above 50%, meaning that he pays off his initial investment every 2 years just in dividends. That's because Coca-Cola has consistently paid and raised their dividends each and every year, while Buffett's initial investment at $3.24 per share has remained constant. So in our example here, let's assume that you consistently invest in a stock with growing dividends over time, and you decide to reinvest those dividends back into the stock and create more dividend passive income from that. Also, we'll assume that the stock price is growing over time at a fairly slow rate, assuming that compound interest takes the value of your portfolio up over time. And because the numbers get very complicated with this type of scenario, I created a very basic spreadsheet that I'm going to be showing you guys here in a second. So again, if you haven't already, make sure to drop a like on the video and let's get straight into it. Alright guys, so here I've created a fictitious scenario of basically you reinvesting all of your dividends back into a growing stock with growing dividends at the same time. Now here under the inputs section, we're going to assume a starting dividend yield of 4%, a dividend compounded annual growth rate of 8%, and then a stock price compounded annual growth rate of 8% as well. Now I've kept these two numbers the same because generally the stock price is going to grow with the dividend yield. So if the dividend yield goes up too high, the stock price will rise so that that dividend yield drops a little bit, and it'll probably stay around 4% for the lifetime. So just to clarify, the starting yield is 4% at year 0, but then also at year 20 or year 30, the starting yield is going to be the same as the ending yield. Now let's just say that we have an initial investment of $10,000. Now with $0 in annual additions with a 20-year time period, this is going to give us a total return of 864%, or an annualized return of 12% per year. So the final value of the portfolio would be about $96,000, and then that would give us nearly $4,000 in annual dividends. So this is a 4% yield based on the $96,000. But I'm pretty confident that most of us have more than $10,000 to be able to invest in our lifetimes. So let's just say that annually we can add $20,000 to our portfolio. So at the end of those 20 years, we're actually going to have a final portfolio value of $1.5 million, having totally contributed $430,000, and this would give us annual dividends of $61,500. Now, just taking a look at these numbers here, guys, it's very easy to achieve this goal just by growing your money over time, rather than having that $1.5 or $2.5 million up front and then throwing it into a stock. With the growth of the dividend, as well as the growth of the stock price over time, we're able to see our total contributions grow into this $1.5 million, which eventually gives us the $61,500 in annual dividends. Now, obviously, we can manipulate the annual addition rate here. So let's say that we could add $25,000 per year. So over a 20-year time frame, this would actually give us $75,911 in dividends per year at the end of those 20 years. So basically, guys, if you're 25 years old right now, you could achieve financial freedom by living off of your dividends by age 45, and you could be getting $75,000 per year. Or if you're 35 years old, you could achieve financial freedom by 55 years old. It really just depends on how much you want to be making in annual dividends and how much you can annually contribute to your investments. Now, you might be wondering really how accurate the scenario is and how possible it is to be able to achieve this in 20 years. So on this other website called the Canada Stock Channel, I pulled up TD stock, and as we can see, they've been growing their dividends basically each and every year consistently for many, many years in a row. And it's actually been growing at an 11% compounded annual growth rate. And what I've been assuming in my projections here is a dividend compounded annual growth rate of 8%. Furthermore, if we go down here, we can actually calculate the performance of TD since 1995 with dividends reinvested. And basically we get this pop-up here. So by taking an initial investment of $10,000, we would get an annual average total return of 15.3% if you had invested in TD back in 1995 and then reinvested all of those dividends along the way. Then if we go into my scenario, we'll just put this annual addition to 0 and then just have an initial investment of $10,000 with that dividend compounded annual growth rate of 8% and then the stock price growth of 8%. We actually only get an annualized return of 12% here. So going back to that TD example, we can see here it's actually 15.3%. So that's higher than the example that I actually gave you guys. So it is totally possible over this 20 or 30-year time frame. So I would say that based on the past performance of TD stock, we can see that they've been doing 15.3% annually with dividends reinvested. My results are pretty conservative here, getting an annualized return of 12%. But of course, once we add those annual additions back in, it does drive down the annualized return because you are adding along the way as the stock price goes up. But now, hypothetically, let's just say that we have $50,000 that we could invest initially into this stock. Well, that would give us a final value of $2.283 million and annual dividends of $91,000. So basically, the larger the initial investment that you have in your stocks, that will give you more in the long run in terms of the annual dividends, as long as you're investing in a company that is growing those dividends and their stock price over time. And also, let's say that we have a longer time horizon, so maybe 30 years. If you're 20 years old, you might want to retire by 50. This could actually grow us to $300,000 in annual dividends by the end of 30 years, just by taking a conservative approach of dividend growth rate of 8%, stock price growth of 8%, and then annual additions of only $25,000. You can easily achieve 6 figures and well into the 6 figures range in annual dividends. And it's really amazing just to know that you don't need these outsized returns like 20 or 30% per year to be able to live off of your dividends. You can easily achieve it just by having conservative results and then consistently investing back into those stocks and reinvesting your dividends back into those growing dividend stocks. And it's totally achievable over time to be able to live off of your dividends. Overall, guys, the amount of money that you do need invested in the stock market to be able to live off of dividends depends on several factors. Some of those factors are your annual income, the dividend yield of the stock in question, the dividend growth of that stock, your investing time horizon, the growth of the stock price, and several more. So it really depends, but on average, it's going to be about $1.5 to $2.5 million that you need invested in the stock market to be able to live off of your dividends. But I truly believe it's possible for absolutely anyone to be able to achieve this goal by living off of their dividends. For some, it might take more consistency than others, but I believe that anyone can achieve this goal. So just keep at it, keep investing, and wait for the long term. Anyways, guys, that's gonna wrap up this video. If you did enjoy, please drop a like on this video as it does help out my channel. And if you haven't already, make sure to subscribe for more content coming very soon. And I will see you guys in the next one.